Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into the Perkins Discovery Fund's annual shareholder report. Get ready for some financial twists and turns because it's not all sunshine and rainbows for this fund. Think of it as a treasure hunt where the treasure might be slightly less shiny than expected. Before we jump in, if you are finding corporate filings interesting, make sure you are subscribed. Also, we have a Discord community linked in the description below. Join us and discuss. This document is a certified shareholder report, basically a report card for the fund. It tells investors how well the fund performed, what it cost to run, and what it invested in during the past year, which ended in March of this year. Let's get straight to how the Perkins Discovery Fund did. For the period from April of last year to March of this year, the fund returned negative 313%. That means if you invested, you would have lost 3.3% of the money, which would sting a little. Now, to put that in context, the S&P 500 index, which is a measure of the overall stock market, returned positive 6.80% during the same period. So the fund underperformed, meaning it didn't do as well as the overall market. The Dow Jones US Microcap Total Stock Market Index, which is supposed to represent the segment that this fund invested in, returned negative 5.72%. Compared to that index, it did a bit better, but still not good. The fund's managers say that micro-cap stocks, which are stocks of very small companies, generally underperformed larger companies during the year, which obviously affected the fund. The fund managers made some changes, adding 5 new investments and selling 7 others, ending the period with 28 holdings or stocks. This is called bottom-up approach, which means that they looked at each and every potential investment rather than look at the broad economic conditions. The top contributors to the fund's performance were Natura Inc., Accession Inc., and Verisate Inc. These stocks did well and helped to offset some of the losses. On the flip side, the biggest drags on performance were Perion Network Ltd. and Neogenomics Inc. These stocks lost value and hurt the fund's overall return. It's important to know what it costs to invest in this fund. For every $10,000 invested, the costs were $252. This equals to 2.56% of your investment. Let's take a look at how the fund has performed over longer periods. Over the past 5 years, the fund had an average annual return of 8.46%, which is pretty good. However, over the past 10 years, that average drops to 4.70%. Again, compare this to the percent, so the fund did better during the most recent 5 years than the 10 years, relative to the S&P 500, which returned 10.50%. So the fund did better during the most recent 5 years than the 10 years, relative to the S&P 500, which returned 10.50%. So the fund did better during the most recent 5 years than the 10 years, relative to the S&P 500, which returned 10.50%. So the fund did better during the most recent 5 years than the 10 years relative to the S&P 500, which returned 10.50%. So the fund did better during the most recent 5 years than the 10 years. Let's see where the money was invested in. The biggest sectors were biotechnology and healthcare supplies and support, each at around 19%. They also had a position in a money market fund at just above 1%. The fund's top holdings, meaning the stocks it owned the most of, were Natera, Accession, and Verisol Corp. Together, the top 10 holdings make up just over 65% of the total investments, meaning that performance is heavily dependent on these 10 stocks. Key fund statistics. The fund's net assets were about $6.1 million. Also, it has 28 stocks. Finally, the portfolio turnover rate was about 10%. This means that the fund managers didn't sell too many of their investments this year. Now, let's change gears to what the company is doing to be ethical. The report confirms that the fund has a code of ethics that applies to its top officers. The report also breaks down the fees paid to the fund's accountant. The fund paid about $16,300 for tax services. Finally, the fund's top executives have stated that their internal controls and procedures are effective. This is basically the executive saying that they have good measures and systems in place so that the company is accurate. Here's what the independent auditor Tate Weller and Baker said. It's a clean opinion, meaning they believe the financial statements are fairly presented. So what's the big picture here? The Perkins Discovery Fund had a tough year, underperforming the overall market. Its performance was affected by the general downturn in microcap stocks, but the fund's managers made some moves to try to improve returns. Looking forward, the fund's performance will likely depend on whether microcap stocks can rebound and whether the fund's top holdings can continue to perform well. The high expense ratio at 2.56% could be a drag on future returns, but it's important to remember that past performance is not indicative of future results. Alright, that's our breakdown of the Perkins Discovery Fund's latest shareholder report. What's your take on these numbers and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.